Welcome back, traders. In this video, we are going to be focusing on one of the most useful smart money concepts, and that is the ICT rejection block. Okay, so in case of if this concept is new to you, maybe you've not heard about rejection block before, or you might have heard about it but you don't exactly understand what it means, then of course this video is for you, so just pay close attention. Now let us understand what this is all about. What exactly is rejection block? In simple terms, it's a price level where the market pushes into an area but then gets firmly rejected. So this rejection forms a footprint on the chart that shows where institutions stepped in to defend a key level. Okay, so these zones often act as reversal or continuation areas, making them critical to identify. All right. So now, the rejection block forms when price makes an attempt to push beyond a level, whether it's into a previous high, or it could be a previous low, or it could be a liquidity pool. But the price gets pushed back strongly. So this tells us that smart money is active at that level. They may be rejecting price to defend a position, to fill remaining orders, or prevent price from moving too far in one direction before they are ready. Okay, so now let us talk about how to identify a rejection block. You look for a candle that pushes into a significant area but closes in the opposite direction. Okay, so once you have identified a candle that pushed into a significant area, all right, but closes in the opposite direction, and that candle needs to have a wick, preferably a strong wick. Okay, let's just see if we can also get another one. So what you're looking for is a candle with a long wick above, rejecting a particular zone, and sending price downward, or that with a long wick below, rejecting a particular zone and sending price upward. Okay, so using this as a reference, you can see that we had a candle here that's pushed into this zone but closed bearish, showing that there was a strong rejection around here. Okay, so this shows that price was rejected. The body of that candle, or sometimes the wick itself, becomes your rejection block. So you mark that zone on your chart because the market often respects it in the future. And as you can see that it was respected here again, right? Pushed price downward. You can see this zone, although this one was just more of consolidation, so we can't exactly say much about this. And then if we push this into the future, you can see that it was respected here again, right? You can see respected here before we had a breakout, and you can see that it was also respected here. And you see that, So you can see that this zone was a significant zone. That zone we identified back there. All right. So one key difference between a rejection block and an order block is intent. An order block typically represents the origin of a move, okay? While a rejection block highlights where price was stopped and turned back. So both are footprints of smart money, but rejection blocks are specifically about defense and pushback. So how can you use rejection blocks in your trading? The first step is to always combine them with market structure. All right. For example, if the market is bullish and you see a rejection block form at a key low, that zone could serve as a continuation area for the next bullish push. But if the market is bearish and a rejection block forms near a high, it could signal a reversal or resistance zone. So here is a simple way to apply it step by step. Okay. First of all, you need to identify the overall market structure. Is it bullish or bearish? Then you look for strong rejections at significant highs, lows, or liquidity levels. All right. Then you mark the rejection block on your chart as a potential area of interest. Watch how price reacts when it returns to that zone in the future, and then yeah, you can use that to find good trading opportunities. So the market often respects rejection blocks because they represent areas where institutions already defended price. So by paying attention to these zones, you can anticipate reactions before most retail traders see them. Okay, the ICT rejection block is all about understanding where price was not allowed to go. When you combine this with liquidity concepts and market structure, you start to see the bigger picture of how smart money controls price, right? But that does not necessarily mean that rejection blocks cannot be broken. Of course, you can see that this price eventually went above this, right? No strategy is 100% guaranteed. You will still have times that the strategy will not be respected, right? So in this place, you can see this rejection block got rejected, right? I mean, it got breached. Although at the end of the day, here, you can see price respected it here. Price respected it here again. And even here, as price broke below it, it tested. So this place became a significant zone, right? In fact, you can see even from here, from this point, even before this kind of form. So that area was already a significant zone. And you can see it remained a significant zone. So that's the full breakdown of the ICT rejection block. Well, emphasis on the rejection. Okay, remember the emphasis of this video is on that rejection, is on ICT rejection blocks. All right. So if this video helped you understand the concept more clearly, make sure to click the like button and hit subscribe so you never miss future lessons on ICT strategies, smart money concepts, and Forex trading education. Thanks for watching, and I'll see you in the next video.